Hi, this is Ting here. I'm going to talk about Link Reit. So I'm going to go through the financial data and the economy condition, market condition that is facing by this Link Reit. All my data is coming from this 30 September financial report, so stay tuned. I think for red assets, right, we want to look at whether it has a consistent growth of DPU over time. So I think Link Reit has achieved a growing DPU over the years. As you can see, the DPU dividend per unit is higher every year. So if we buy at a price of 35 to 36 Hong Kong dollar, we'll get a dividend of around 7.6%, which is pretty high. And then the revenue for this rate is also growing in a yearly basis. So it means that the management actually put effort in manage the property well, cut costs, maintain good operation efficiency, and then acquiring assets over the years. Link Reit is the Asia biggest REIT. It has a portfolio value of around 222.9 billion. Most of its asset is around in Hong Kong and China. So Hong Kong has 74% of asset, and then China has around 13.8% of asset. So add up together, Hong Kong, China around 89% in portfolio. So for Link Reit, the gearing ratio is around 22.5%, which is pretty low compared to rest of the Singapore rate, which is around 40%. So for Link Reit, their occupancy rate is also quite high. It's posting around 95% of occupancy rate in Hong Kong and China, and then for Singapore and Australia will be even higher. The net asset attributed to the shareholder of Link Reit is around 61.19 Hong Kong dollar. Currently, the stock price is trading around 35 to 36 Hong Kong dollar. If we look at the price to book value, the price to book value of Link Reit is around 0.57. If let's say the price to book value is less than 1, means that actually the company is trading less than the asset value. So Link Reit is trading about half of the net asset value. Another thing to take note that actually the price to book value of Link Reit has been decreasing. This is due to the decrease in share price recently. From the technical analysis perspective, we see that actually the stock price has reached a support level. Currently, the support level is around 34 or 35 Hong Kong dollar. So we have reached this support level, but I think there's still another support level at around 31 Hong Kong dollar if it continues to fall further. So I think the price currently has reached a support level, but we won't know the future stock price movement. So let's use this as a reference. If we look at the income statement, we will know that the profit attributed to the shareholder for recent years is negative, especially in the 2023 and 24 and 25. This is because there's a change in fair value of properties. The Hong Kong and China property has experienced some decrease in valuation due to the challenging economic condition. So I will expand on this topic later. So for this part, I'll be covering the Hong Kong Chinese retail renting market. So as you can see, currently the Hong Kong and Chinese market, they are undergoing some economy pressure. So the Hong Kong market is suffering some rental reversion of around 6.4%. And then the Chinese properties also has some decrease in net property income. Means that the rental also decreased around 4.4 to 4.8%. But I think the good thing that the management mentioned that is the Hong Kong and Chinese property has still remained a very high occupancy rate. It's mostly is above like 95%. If you can see the data I present previously. So for the valuation part, we can see the total valuation of the investment property decreased by around 3.1 billion. So the main decrease come from the Hong Kong properties and also the Chinese properties. But for the Australia and Singapore properties has experienced an increase in valuation. So this helped reduce the downside for a bit. The management also projects some outlook for the Hong Kong and Chinese property market. So they expect that negative rental reversion to continue until the second half of 2025 and 2026. And then it's expected to bottom up afterwards. So the recover may be gradually, but the management also see there's some positive catalysts like the lower in funding costs in Hong Kong and the reduced and the rate cut in US rate will provide business confidence. For Link Reit's international portfolio, the portfolio spans across retails and office asset, primarily in Singapore, Australia, and United Kingdom. The Australia has 9 properties, Singapore has 2 properties, and United Kingdom have 1 property. So the United Kingdom portfolio is slightly negligible. Link Reit's Australia portfolio has recorded a robust rental reversion of around 16.3%, and the management is very optimistic about the consumer demand, underpinned by population growth, rising household income, and positive consumer sentiment. For Singapore, Link Reit has 2 retail properties, which is the Jurong Point and the Swing by Thomson Plaza. Both maintain a good performance, has an occupancy rate of 99.8%, and recorded a positive rental reversion of 12.9%. The Dividend sales record a temporary uplift, driven by the SG60 promotional campaign and expected to normalize at the end of voucher distribution. For the strategy part, we know that Link Reit's strength is managing retail shopping mall, especially in Hong Kong. So going further, the management strategy is to remain in low leverage and focusing on expanding portfolio, looking for opportunities in Singapore and Australia. So the management will be focusing on these 2 regions. So here is my take for the Link Reit. So I'm sharing something I like about the rate. I think the 7% dividend payout is quite attractive, but this point should be combined with the 35 to 36 Hong Kong dollar share price that we currently have. Some of you may argue that actually this stock is a dividend trap. So the definition of the dividend trap means that the high payout is due to the falling stock price. So I think this argument may be true for Link Reit, but combining the factor of the high payout with the current share price level, I believe that the downside will be limited. As an investor, I believe that we need to be prudent with our decision. So this is just my take. I think as an investor, we also won't know how much the downside is going to be. So it's better to have a habit to buy in small batches and have enough holding powers. You help us to weather through the downside of the share price. Link Reit has most of the portfolio from Hong Kong and China, particularly in Hong Kong. So we know that actually these are the economies that are facing some economy challenges, and then the retail sentiment is quite subdued in these areas. From previous report, we know that actually this region has endured some negative rental reversion, particularly on the Hong Kong and China. Furthermore, the management also say the outlook for this region is expect there will be some ongoing challenges on these 2 regions, and then this challenge will continue until the second half of 2025 and 2026. So I think this is something that the investor need to take note. Here sums up my video. So if you like the content, please consider like the video and subscribe to my channel for further updates. Thank you. Bye.